Okay, as this will be recorded, so if anybody misses something from the very beginning, they can certainly look back at it. But let's go ahead and begin our intro to options, really. It's, I think Maddie had an elegant way of describing it as the uncovering the mysteries of options. And there are some nuances to options that do need to be aware of as you use them. I think options are that area of the market that a lot of people, when they first start trading, dip their toe in and get it chewed off by piranhas pretty quickly. And it's I think it's because it's a different beast, very much so, than just a security. There obviously are relations between them, and we'll go through some of those so that you can make sense of options and can use them to both protect your accounts and your positions, as well as amplify positions where you want to. One of the amazing things that options allow you to do is to be so much more precise about your call and get paid incrementally more when your call is correct than you could do with just a future or a regular equity position. Let's just turn this up a little here. The very first option that most people ever will run into is a call, and the most basic position is probably just a single long call position. What that means is that it gives you the right to buy something at a certain price over a certain time. So puts are the right to sell something, to sell a security, and calls are the right to buy that security. The price that you're going to pay for that is called the strike price. So, for example, in this, on what we're looking at is a small chart of a $60 call for company XYZ. So you can see on the chart at $60, there's an inflection point in the value of the call in the future. And the reason that that's not an inflection point right here, the reason that this distance between the yellow line and the black zero is the amount that you paid for the call, for the right to have this purchase price. And that's called your premium. And we'll get into that in a little bit. We'll break down what that premium is made of. But all options are bought and sold by their premium. That's the cost of the option. And the nice thing about it is if you're buying them, that's also your maximum loss. So if you bought this if this was $1, that's all you could possibly lose by owning this call. The upside is unlimited. As you can see here, at $60, it's not worth, you've lost your dollar. But very quickly, this moves up to, say, $65, you're in the money. Now you're making a profit at expiration. At $70, the call you bought would be worth $9 if you paid it would be worth, well, $10 minus the dollar you paid. So it would be worth $9. And so that's why it's considered an unlimited upside and yet a finite loss. The flip side to that is a short. It's a put. This is the right to sell something. In this case, it's a $60 put, which means we've paid this premium, which is, again, is the maximum loss that you can have. And in this case, the option is going to become more valuable as the price of the stock falls from 60 to 55 to 50. The final distance here would be the strike price to 50 would be $10. The put would be worth $10 if the stock fell to 50. Now you've paid the dollar to buy that, so it wouldn't be quite a full $10. You'd have to take off the dollar that you paid, and your profit would be $9, or the value of the position net of the premium. So these are the two most basic options, and all of the other options and condors and spreads and everything that you hear about that can be very confusing and complicated are just combinations of these two elements. So now looking at that price, what makes the option price, what is that premium built from? There's really two main components. There's the intrinsic value, and then there's the time value. For an in-the-money option, and by in-the-money, we mean one that has a strike price that is lower than the current price if it's a call, or higher if it's a put. For simplicity, let's just go through the call case, and we'll say that we have a $55 call for a stock that's trading at $60. The intrinsic value would be, one way of looking at that is to say, what if we went all the way to the expiry of this option? What would that difference be? Well, in this case, it's $5. So at the end of the option's life, if the price is still $60 for the stock, the option will still be worth $5. Now, because there's a high likelihood that the stock won't be $60 still, there's a value, a time value to the option that is based on the likelihood that the option could go higher or lower than that price. That's built on the volatility of that stock. So the more time you have in the option, for example, if you were buying November calls instead of October or September calls, you will have a lot more time value built into the premium. That's why when you go out there, you'll notice the same strike price options cost a lot more when there more and more months of time is available on the option. The option, you've optioned the price of the right to buy that stock for a longer period of time, so it costs more. And one of the main reasons is the time value. Now, if you have an out-of-the-money option, one that has zero intrinsic value, for example, if we bought a $65 call and the stock price was $60, so we're $5 out of the money, then in that case, there's no intrinsic value, because if the stock price stays right there all the way to the end, it's worthless. So it's intrinsically worthless. It only has value in that you have time for that price to change in your favor. And to the degree that there's volatility in that stock and that there's a decent chance that could happen, the time value essentially will be the premium for out-of-the-money options. Calls and puts, it's the same difference. And the text here describes that a little bit. I'm trying to put it into a little bit more mental picture way of looking at it, but essentially those are the two main elements, is your time value and your intrinsic value. These are now when you look at the factors that would influence those options prices, in addition to the two, or really factors that affect the intrinsic value and the time value, are these 6 elements that drill down a little farther and looking at the value. One of them, of course, is the underlying price. By that they mean the underlying price of the stock that you're talking about. So again, if the underlying price of the stock is higher than your call, then your call is already in the money. It's going to actually have intrinsic value. So underlying price is definitely going to be a factor that influences it. The strike price of the option that you're looking at, and we'll look at multiple strike prices here in a second. The time, which we talked about, the time value, the implied volatility. These are all factors that affect time value. And dividend and interest rates are really far less influential. They do influence longer holdings of options. It is measurable, but it's not nearly as much of an impact as the first 4 items are in affecting premium. Now, one of the things that you have to build into this also, which they don't really talk about, but if you're not holding the option until its expiration, there's also a big factor which really influences implied volatility, which is expectation. The options prices don't move linearly with the stock price up and down necessarily. Sometimes if people are really expecting a move, for example, maybe there's an event coming up, or the stock just made a breakout through a certain point, options prices will jump, will be higher because of everyone's expectation that there's a directional move going on. That's hard I think, for you to put into a formula, but you'll see when that is certainly something you'll have to learn to deal with in trading options. So when we start combining the various types of combinations of puts and calls, one of the first and probably most straightforward is the spread, which is a little bit different. You can see by the chart that we have here. You can see essentially there's two corners, or two options being in play, and that's what's creating a zigzag chart essentially. In this case, the example is that you're long a $60 put, and so you've bought one $60 put and you've sold a $55 put. Now what that does is the long position, because it's a put, this is just like the one we were looking at before where it goes to 60, it has an inflection point and it heads up. But what it's telling us is at $55, because you've sold this put, your profit stops going up. So you've limited your upside, but you've also limited your risk. And you've done that by getting paid for the option that you've sold. So what would happen is if you had the $60 put is going to be more expensive than the $55 put because it's a higher priced item. So you might have paid $2 for that one, and then the one that you sold, the $55 one you sold, maybe you sold that for $1, and so the net cost to you was just $1. And yet you still have the ability to make the difference between these two, which is $5. So whenever you're looking at a spread, the thing to do is to take a look at the two strike prices, because in the difference between those, that's going to define the maximum value that spread can be worth. Then you have to determine based on that how much would you be willing to pay for it. We'll look at some spreads in specific stocks as we go further, but essentially that's what this is doing. You're risking less money for a defined gain. Now in this case, well, I'll just show you the next one. There's another case where you can do this same spread or a similar, you can have a similar risk profile, but in this case you're selling calls instead of buying puts to create the spread. Many times a good place to use these is if you think that you're close to a top in a stock and you'd like to sell a call into that, but you don't want to have an open-ended risk. So you short one of the calls, and then you find a call that's farther out of the money, and you buy it. And that, again, caps your risk in just the same way that we were doing before. You start here with you've sold the $60 call, so this amount of money between here and here you put in your pocket as a profit because you get the premium from the option you sell. And then to minimize that risk so that your loss doesn't continue on to infinity, you use a long call at $65 strike to cap that risk. And you do pay a little for that, but then you've capped your risk. The same idea occurs in that you can your maximum gain is the difference between the two strike prices, and the difference in this case, because we're selling it, is you get to keep all of the premium from the first call that you sold, and then you just wait and see how much of that money do you have to pay back depending on where the stock price goes going forward, and ultimately to expiration. If it goes all the way to expiration, then this chart defines exactly what your payout would be at each of these prices, whether it's 55, 60, 65. You're making money here, and you're losing money, it looks like somewhere in between 60 and 65, but you're capped, so you can only lose this much. Anything higher than 65, if you're that wrong and it just continues to roll through the spot you thought was the top, then at least your losses are capped at $65. So that's two ways of using the spread. One is just where you buy the spread and you're betting that it's going to go in a certain direction, but you're essentially you get paid at the end. That's where you put on a bear put spread, where you're buying the more expensive option. And then the second one, where you're actually selling, where you're shorting the spread, you're selling the more expensive option, and in this one, all of the money is in your account to start with, and then the result of the trade, you determine how much you give back. So there's a subtle difference in that in the cash management of the account. One of them, money goes out, and then you get back what, depending on the success of the trade, and the other one you give back the premium that you gained by shorting the call initially. Another variation of these is more complicated still. It's called a butterfly, and what this allows you to do is to pick a very specific price, and it can be near or far from the current price, but in doing so, your return is quite high at that very price, and your loss is capped in either other direction, so that many times you can use these. I know that Phil has mentioned some of these in the chat room frequently, using either buying or selling a butterfly, and one of the reasons is that you can often put these on for very little net cost, and the construction of it goes like this. There's a long tip. Each tip of the butterfly wing is a long position. In this case, it's just a straight long call butterfly, so all of the options are going to be calls. You're going to buy a 65 call, and you're going to buy a 55 call. In the middle, the 60, you're going to sell two calls in between them, and that's going to define the price that you're going to make the most money. And the reason is, if the stock is at 60 at the end of the expiration, then the premium that you get to pocket from shorting these two calls goes directly into your pocket. That is right here. That's 60. This is both of those premiums add up to this number, whatever that is. Maybe that's $10, and you sold two of these for $5 each. Any deviation from that, you're going to make a little bit less, because you've paid for, you've bought these other two calls. And what these other two calls do is they cap your risk again. By being short 260 calls, if the market were to continue to go beyond 65 to 70, you would start losing more and more money being short those calls. But because you have bought a 65 call and a 55 call that offset that caps your risk there, and you're no longer liable, because those options will kick in, and at this point you have two long calls and two short calls, so that's why your risk is no longer there. That's why this just goes straight across, because at that point, at 65, this second call kicks in, and you're no longer losing money. And the same is true of the other direction, because at this point, at 55, your long call, both of your shorts are paying you, so they now overcome the two that you're short overcome the 55 call, and you're no longer losing money that direction. So either way, the long calls cap the short position. The short position really defines where your value is. Oh, is there a question? Someone breathing in their mic? Is everything okay? Okay. Does it sound good? Is everyone hearing me well? Is that working before I go on? Okay. Yep. All right. Okay. So that's a butterfly.
I can hear you, Chris.
Okay. Great. Thank you. That's the butterfly. The butterfly is a great trade, again, because you can put it on. It's something you can trade either short term or longer term. I think it's more popular probably among the multiple month traders.
We did this exact trade for Apple. Exact trade we did for Apple last for
Yep.
the earnings.
Yep.
We did this trade. Phil designed the trade, the butterfly trade for us, and that's exactly the trade I made and I put on, and it was a big, big winner.
Yep.
So thank you, Phil.
Yep. No, that was very good. Definitely.
No problem.
Now there is a variation of the long call. Wait, which I want to get to. Well, no.
Well, let me just say one thing, though, Chris.
Yeah, go ahead.
In terms of butterfly,
Yeah.
you need to know levels. That is probably the most important component
Yep.
of the butterfly, is knowing the strikes to actually play. You know, like a lot of people just like put on calls and puts, but when you play the
I agree with you. Because you're being so specific about the price, you're literally picking. You're not just saying, oh, anything higher than this. You're literally defining that level. The butterfly works very well in combination with your levels, especially some of those longer-term levels on individual stocks. Where you'll find, like Apple, where you're saying it's not going to get higher than this, but it's definitely going to go up. That's a perfect position to put a butterfly on. Now, the next one, these are the straddle and the strangle are variations of each other, essentially, where you're betting on that a stock will either move or won't move, but you don't really know which direction. So it's almost a bet for or against volatility. And this is another way of using options where they're not as directional as the first combinations that we were looking at. But many times, for example, for an earnings call or something like that, I think we used a short straddle, or no, a short strangle on Priceline when we did the earnings call, and that worked beautifully. We sold both a call and a put. And the strangle is probably more popular just because you can widen it out as wide as you want. You'll notice the 65 and 55 for Priceline, it was 1,025 on the top side and 825 on the bottom. Obviously, it's a much higher priced stock, a lot of volatility, but even that far apart.
actually 820.
Or maybe it was 820. Even that far apart, there was still a $3 or $4 premium on each of these options, and you basically get to keep the premium in a short strangle. Now you can either of this, the straddle, you'll see they're basically just the same price. So you have the same strike price. You sell a call and a put, and that's your premium, and you win if it can go if it doesn't go anywhere. If it stays within that boundary. And if it doesn't, it'll keep going on you. Now, one of the risks is that the maximum loss is unlimited. And so many times people will turn a short strangle or a short straddle into a condor. And you do that, essentially, you can see here's the two short positions again, and you just cap your risk again, just like we were doing with a spread. It's basically two little spreads. You have a spread, a 65-70 spread, so you're capping the risk at 70, and a 55-50 spread. And when you put them together, they're essentially they're a short condor. And now the position will win anywhere in between here. You get to pocket the premium that you pay, that you got from selling the 65 and the 55, and then the farther out of the money and therefore cheaper options are your cost. They come off of the premium that you got, but that caps the risk going forward. It's another safe way to bet that a stock is not going to move. Now,
what I've done with SPY is I shorted, like I wrote a call against 175, and I shorted a put for 145. So, like, right now, as long as SPY doesn't go to 145, I'm good. And until SPY goes to 175, I'm okay. So that's how options can help you, like, make money. Because if you short a level, like 175, you short 175 calls until it gets to 175, but you can always, like, adjust it based on open interest. You will win. And that's what I've been playing for, like, the last 4 months, probably. Write a call at 175, short a put at 145. How do you lose? That's the beauty of options.
Yep, exactly. No, I think you're right. That's actually more this model right here, isn't it? The short strangle, essentially.
Yep.
Yeah. You don't. If you wanted to add the protection on the other side, it becomes a condor. You don't have to. One of the differences, though, is that the margin, your broker will charge you more margin if you're just short two options like this because of the unlimited risk. Then this position actually takes up. You can do this position with far less money in your account, and that's one of the reasons that the spreads are so popular, because the risk is defined in each case. The broker realizes, oh, well, then as long as they have that much money in their account, I don't have to worry, and therefore you can put on more contracts if you wanted than you would be able to with just a straight short strangle. Those are these will make a little more money because you don't have to give up the protection money on the end, and larger accounts would use this structure. That's why Maddie's using this exact structure for the SPY. But for people that don't have that size of account, the short condor is very popular. And you can flip these all into long condors where you're betting that there is going to be movement, and you're out this premium. Just invert the whole shape of it, and it's the same thing. But now it's a play that there will be movement, whereas this is a play that there won't be movement outside of the range, the strike prices that you've chosen. This is this is just your typical options chain. I threw one in here just so people could look at it a little bit. There's some features to it that I want Phil to go through, but I put it in your pack so that you would have it going forward. Now I want to show you a couple of things that added after the slideshow was put together, and one of them is it's after hours, so we're not seeing all of the bid size and ask and volume and open interest, but this is essentially an options chain for a spread. And I wanted to show you the difference. In this case, I have picked a width of 2 strike prices. This is Apple, and there's 8 days left. These are September, I guess they're the September 3, yes, the September ones, the September monthlies. By picking a width of 2, that means there's 2 strike prices. So these are $10 apart in each case. And with a strike price, with a current price of around $4.65 or so, you can see right here is about break even. So if you wanted to bet that Apple stock would go over $4.75 in the next 8 days, this spread would be worth $10. The current market price is somewhere here. It closed at $3.80. So you would make about 250% on this spread if you're right. If Apple goes over $4.75 in 8 days. As the likelihood of that happening goes down, you can see if you were right that it would go over 500, so that the 490-500 spread would be a winner. Well, you can put pennies down if you're right and you're that far away from the options. It's very unlikely. But also notice, going into the money more, you can actually get a return buying this spread. This one, all Apple has to do is stay right about here at $4.65, and this spread will be worth $10, and you only have to pay $6.50 for it. $6.30 was the last. So this will make 60% return if Apple just stays here. So those are sometimes an interesting way of looking at.
What I've been doing
Yeah.
for Apple,
Yeah.
I'll tell you. I've been selling the puts at $3.85 because that is where Apple bounced. So I've been selling puts at $3.85, thinking that it's not going to get to $3.85, and selling calls at $5.25 or $5.50, because $5.25 is the top of the gap. So
Okay.
if
Right.
you actually look at the price, and it's on the charts, this is not something like, I'm not a genius, I'm just a trader. Hello, I'm not a genius. I look at where Apple spiked to last quarter. It was $5.25. That's it. $5.25 was the high.
Yep.
$4.80 was the low. Where did Apple go to? $3.85. You just sell puts at $3.85. You write calls at $5.25. Gold, it's all gold.
Yep.
You're golden. And what's my cost? Nothing.
Just the time value of the money, because you will tie up a certain amount of your account in margin. You can minimize that by doing just what you're saying, going to $3.85 and selling that put, and then go to $3.60 and buy a put, and then so you can cap that risk, and you can get away with it even cheaper. So if you're doing this, if you wanted to mimic that trade that Maddie puts on, just go a couple of strikes past it and buy a put or a call to cap your risk, just like we were showing in the Condor. Exactly the same strategy, and it is a very good strategy. And when you apply those levels that Maddie will point out to us in chat, the risk is even that much more unlikely that these will be hit. So the premium is just money you can pick up, basically. She's right. Anyway, I wanted you to see the way that they structure some of these, the costs on a spread is a little bit different. You can, most of this is the Trade Monster platform, and they have, you can look up any types of trades. The Condor, the Iron Condor's here, the regular Condor. If we put this, take a look at this one. They're complicated strikes, but you can see there's a current bid and ask for all of these, and depending on the liquidity of the stock, which is one of the reasons that we like to stay in the most highest liquid stocks, so that these options are actively traded. You can put in quite a few of these. But again, all of these, as complicated as they sound, they're all made out of puts and calls. That's it. Just different strikes, different combinations to create and to make specific types of bets, whether they be bets that the stock is not going to get out of a range, like Maddie's describing, or whether they be literally a specific price because there's a level that it'll go to and you're pretty sure it can't get through. That's basically what you're doing. You're just combining these in different ways. So they're once you realize that, I think that'll help take a little bit of the mystery or the confusion away from what's going on or what these calls are doing. All right. Now, I wanted to show you a website that is pretty good, and I'll post it in the chat as well. It's the Option Industry Council. They have a lot of resources there for just understanding some of the basic principles of options. They even get into some strategies, but I find their description are very good, and they can go over some of these concepts. I don't want to go too in depth into what they call the Greeks of options, because they get complicated pretty quick, and I think they're something better to be studied with reading it yourself than trying to listen to someone describe it, because it gives you the chance to look at it and reread it and kind of think about it a little bit. But essentially, the delta, for me, the delta and the theta are the two that I would recommend becoming acquainted with first. And the delta is basically how much the premium of the option will change in value for every dollar move up or down for the underlying stock. And so essentially what you're doing is you're looking here and you're saying, okay, if you have a delta of XYZ goes up, say $60 or 60 cents, with a delta of 50, the option will only change 30 cents. And those deltas, they're available for on almost every platform, but essentially just allow yourself to think of delta as that rate of change. So if the stock moves $1, how much should I expect my option to change? And you can see what they've done here, what this little chart is, which is useful, is it shows you, given the stock price, a $60 call will have vastly different deltas, whether it's in the money or out of the money, and by how much. So at $40 or $45, because you have a $60 call, which means it's way out of the money, the delta is going to be very small. I mean, if the stock goes from 45 to 46, you're only going to get a 3-cent rise in your call. It's too far out of the money to be a risk to the option writer, essentially. So he doesn't need to move the price much. As you move that cost up, though, at $60, well, now you're looking at a delta of about 55 or half. So at the money, this call should move half as much as the stock does, up or down. Now, as you can tell, because up the delta climbs and down the delta falls, so that at $60 as it falls, it'll fall less and less and less than the stock price. And if you're going up in price of the stock, your delta increases rapidly until basically it's moving dollar for dollar with the stock price. And that's so looking at that difference and realizing that how delta works, it's I think it'll help you understand why your options, or it'll give you a way to have an expectation of how much your option will change in price given a stock price movement. The other one that I like to look at is theta, and theta is the Greek letter term for time, the time decay. And so what this one is telling you is how fast does the time value portion of my option decay per day, essentially. And in this case, you can see that there's a big difference between being at the money or in the money or out of the money. All have differences to how fast they would decay. And you can go through that, but I think just recognizing that there's such a thing, that it can be measured, that you can look at and have a feeling for each day, how much is my option going to lose in value because of the time element, is an important thing to be aware of. There is any option has time value, and therefore any option will lose value over time due to theta. Now, hopefully you're going to make that up in either the direction going the direction going properly and your trade winning, or if not, you can be on the other side of this, which is selling those options. Again, like the condor idea or the straddle that Maddie was talking about. If you're short those options and they're melting away every day, that's money that's actually melting into your pocket. And so that's how those options that's how options sellers can make money off of this same concept, basically theta. Okay, I guess at this point I've gone through what I wanted to go through, which was some of the basics about the option structures, combinations, and I think I will pass the baton over to Phil to take a look a little bit at an options chain and answer some of the questions that people had about perhaps information, what can be gleaned by looking at an option chain, and some of the other questions we can get to after that. I know Liam had one question about iron condors. Hopefully we've hit that one already, and we'll go from there. So let me just change this over, and I'll pass this your way, Phil.
Alrighty. At risk of sounding like Debbie Downer here, let me just offer my 2 cents on the issue of selling options.
Yeah.
You can collect premium, and certainly the way options are priced, time, as CP mentioned, works in your favor when you're selling options. On the other hand, you also need to be very, very careful of what price you are accepting.
No Debbie Downer here.
No, you need to be careful what price you're accepting for taking on the risk, because
all you really need to know, seriously, guys, is the levels. And that's what we give to you guys. We give you the levels. And if you know the levels, where SPY, Apple, Link, Amazon, Google, Tesla, if you guys know those levels, guess what? You can structure any option strategy you want to play. But you need to get and understand price. If you understand price action and you understand levels, all this stuff becomes very easy. That's what we give to you. You know, like, it's not complicated. Like, I look at this every single day, and I look and I say to myself, like, where's the buy wanting to go? Where has it been? Where is price telling me it's going? Like, seriously? We could go to 180 and spy. We can. Because price is showing me that 180 is a possibility. Just like I thought 125 was a possibility a couple of years ago. And you know what? We got to 125, we bottomed, boom. We've been taking off since then. You know, like, I'm not perfect, and I see what is happening. I don't know why price is dictating 180 in SPY, but it's showing me it. I can see 180. I don't want to see 180, but you guys just need to understand price. Anyway, that's what I wanted to say.
Okay. No, those levels are definitely powerful, and whether you use them just with the stock, you know, the shares of common stock to buy and sell the levels, or you want to exploit the power that options have to really bring out, I think, even more value with less risk, perhaps, to those levels, I think is really what we're hoping to present a little bit today, just so people can see you can do this with a relatively small account, and options will help in that regard, help you put those positions on in many different ways, but definitely knowing the levels, because you have to have an idea of what you want, what you think is going to happen before you start constructing your options trades. Sorry about that little interlude there, Phil.
Oh, that's all right. No, I just want to, again, I agree with Maddie in the sense that if you are comfortable with a level either to the upside or the downside, and you're prepared to take risk above or below that level, that's fine, as long as you know what you're running, what your exposure is. I mean, I think the classic example of what I was suggesting earlier in terms of knowing what you're collecting is what happened back in January with Netflix. Netflix went into earnings with a gigantic short base, and right before the earnings release in the afternoon, the 175 calls were trading for 80 cents, and the stock was at 100. Well, 2 days later, those calls were trading for 12 bucks. If you had sold those options naked, those call options naked for 88 cents, and 2 days later you had to cover them for 12 bucks, it would have hurt. So understand the risks in selling options. They're very real, and that's why most brokers require very significant margins to let you sell options, and it becomes outright prohibitive to outright sell options on indexes like the SPX or even the SPY. The margin requirements are even larger for the
and the paperwork to even enable your account to do that is a lot more onerous.
Yeah, the paperwork is I mean,
that's telling you something too.
There is no free lunch, and when you sell options, yes, you have a lot of things going for you, but there is also the real risk that one of those times something will blow up in your face, and you have to have the wherewithal to make good on a trade that can go horribly bad on you. So just be careful. I'm all for selling premium, but it's not without its risks. So let me turn to now to an option chain, and unfortunately I'm going to have to dig a little bit into the various Greeks. I will not go into the details that I have done, as I have done in the past two webinars, and I think Chris may have those available on YouTube if you guys are interested. But it is sort of impossible to.
Phil,
Yes.
next webinar, we are going into the Greeks.
Right.
Because they're important.
Well, yeah, but even on a very basic level, let me just offer up a little bit of what you see on an option chain and what you can read out of it. Here we have, I think everybody can see, it's an Apple October option chain, and you have your strike price, your bid, the ask, the volume for the day, the open interest, and that's just information that is available, just about anywhere for free. Then you get into the delta that Chris had touched upon, and implied volatility, theoretical value, and theta, time decay. So here is what I would offer in as sort of a rule of thumb on how to interpret an option chain when you see it. The first is the delta. Chris explained that the delta is the rate of change of the price of the option for each change of $1 in the underlying stock price. There is also another approach to another message in the delta, which is not exactly straight out of the Black-Scholes formula, which is what creates option pricing. It's more like it works, so to speak. And what the delta can tell you is the percentage probability that that particular option will be in the money, even if just by 1 penny, by the time the option expires. So let's take the Apple October 465 call. It is $15 more or less at the midpoint, and it has a 0.52 delta. Easy enough to understand why, right? The 465 strike is just about where the stock is trading right now. So statistically speaking, there is a 50-50 chance that the stock will be 465.01 or below 465 by 1 penny. Why is that useful to know? Well, especially if you do employ strategies like the ones that Maddie was suggesting, to sell way out of the money options. This gives you a very quick snapshot of what your statistical probability is that you will make money or you will lose money. So let's take let's go way up to 550, which is one of the levels that Maddie was suggesting for Apple. You can see that the delta is 0.04. Well, this suggests is that there is a 4% probability that come October expiration, the 550 calls will trade in the money. In other words, the price of Apple will be at least 1 cent above 550. So the way you can use is that you look at the price and you see that it's 65 cents. You say, am I willing to accept 65 cents now for a 96% probability that those options will expire worthless. And then you make your call. That's how the delta can be used if you want to stay away from the Greeks and how it impacts prices and whatnot. That's sort of a useful way of looking at the delta on an option chain. It gives you the probability that that specific option will be in the money by at least 1 penny come expiration. Now, obviously, the delta changes, and we're not going to get into how and why and what causes it to change, but it changes. So you need to adjust your probability comfort all the time. If you start seeing the price moving against you, and let's say you've sold those 550 calls, and Apple tomorrow, Carl Icahn comes out and says that he has bought another $3 billion and the stock goes to 500, well, that delta all of a sudden is going to be probably closer to 10%. And this price is going to be quite a bit higher. So in that moment, you will have a paper loss. The question is, do you still feel comfortable that the 90% probability at that point, instead of the 96% probability, will realize itself, and those 550s will eventually expire worthless? Okay, so any questions about using the delta and in that way? If you do, just shoot them up on the little panel. Implied volatility. All right, implied volatility is, I tend to differ a little bit from what Chris was suggesting in terms of delta and theta being the two most important items in pricing on options. I tend to view implied volatility as the single most important element of pricing on options. I'm not suggesting Chris is wrong. It's just sort of my approach to things.
Well,
And,
in my defense, I don't know that I really considered implied volatility as a Greek. And I was suggesting of the Greeks, I thought that delta and theta were the ones that I would look at. But
okay.
you are right. Implied volatility is where the rubber meets the road.
It's basically what implied volatility is, without getting into the math side of things, is a measure of expectation by the market makers, by those who set the prices of the options, of how much the stock will move over a 1-year period. It doesn't tell you whether it's going to move up or down. It simply tells you that their expectation, let's go back to the Apple example at 465. Okay, they have a 26%, 26.15% implied volatility. What that says is that the option market makers guess, in essence, using some mathematical inputs, but nonetheless guess that the price of Apple over a 1-year period will move by 26%. And they don't know which way, but they know how much. And why is that important to know and to understand in the context of how much you're paying for an option? If a stock, and I'm going to try to keep it very simple here, but if a stock has a historical volatility, and that's not a guess, that's the actual swing range that a stock has had over, let's take a year period, and we'll call that the historical volatility. If a stock has a historical volatility of 13%, and you are buying an option with an implied volatility of 26%, in essence, you are deciding that the stock will deviate from its historical swing range by 100%. And you're in essence stacking the deck against yourself, because one of the things that statistics tell us is that on average in the long run, the statistics work. So if statistically speaking a stock has a volatility of 13 and you're paying 26, it's going to be a long, tough challenge to make money. So the way you want to use implied volatility on your screen is to compare it to the historical volatility. Now, I do not have historical volatilities on my option monitor. It can be put there if you want to in most systems. But what I have is something that is slightly, it's basically the same. And it's called the theoretical value. Okay? The theoretical value in and this is again not precise as a definition, but it's close enough for our purposes. The theoretical value tells you how much the option should cost, and I'm talking about the price now, not in implied volatility, what the actual price of the option should be if the volatility of the stock behaves in the way that it has behaved in the past. So let's go back to our October 465 calls. The implied volatility is 26%. The price, if you take the midpoint, we'll call it $15. Okay? The theoretical value that we're getting here is $17.30. So what that tells us is that if Apple stock over the next month or so, month and a week, behaves in the same way that Apple stock has historically behaved over a 5-week period, the fair price for that option should be $17.30. The market makers are being generous here because they don't think that the stock is going to move that much. And they're offering the option for $15. So on a purely historical versus implied price, these options are relatively cheap. They are buyable with a reasonable expectation that you may be right. You're not overpaying for these options. Now, unfortunately, it's not as simple as that. It may well be that there are circumstances which are inflating or deflating the price of the option right now, which were sort of a one-off item. So you do need to look at, even when the theoretical price, when an option seems cheap, you need to check into why it is cheap and try to understand whether the reason for that relative cheapness is something that is likely to recur or is just a one-off kind of situation that is built into the numbers. And for that, I'll take you to a different screen, and this may be a little bit trickier to find in certain systems. But on this screen, what it shows you is the historical volatility of the stock over a period of time, 1 month, 2 months, 3 months, 6 months, a year. And the implied volatilities at which that particular, the options, the at-the-money options, are trading at that given time. So as we said before, right now, the historical volatility of the stock for a 5-week period is 32.6%, where instead the implied volatility of the options is 25%. Hence why those options are cheap to theoretical value, which is calculated based on this number as opposed to this number. Again, we have gotten into how to use and how to build implied volatilities and delta and other things into your strategies, much more in depth in the other webinars. We're trying to keep it relatively simple today, so that we don't confuse things too much. Let me just touch on a couple of things that Chris discussed, and it has to do with butterflies and spreads.
Yeah.
One thing that people should not raise their expectations too much when getting yourselves into spreads or butterflies is that it will be an immediate gain. When you are buying delta and selling delta, and as you remember, delta is the rate of change of the option price, the net change in your spread, in your overall option position, is going to be the delta of what you bought minus the delta of what you sold. So one thing that, from a practical standpoint, I would encourage everybody is that if you get to buy a butterfly or a spread for very little money, you will watch that thing move very little initially. The bulk of the move will start occurring when the time decay of the option that you've shorted kicks in, because time decays, the time value of the option decays at an exponential level. And that's when you're going to start seeing your spread value increase, assuming that the underlying stock price behaved the way you thought it behaved, obviously. And so you got to be patient, and also you cannot be too greedy. When we're talking about butterflies, you got to pick your levels. It's probably something that should be splattered on your screen in big red letters, because if you wait to hit that particular level to the penny and make every little bit that your butterfly could make, you're going to be disappointed. The reason why butterflies are low risk positions is because they're also very slow developing and not home run type plays for the most part. You got to take what they give you and be happy to incrementally pocket some of your money and just roll it into the next one and just keep going. It's hitting doubles, singles and doubles, as opposed to trying to hit home runs with butterflies or spreads for them. I think that is it if we're going to keep it sort of simple. And if you guys have any questions, I know there was one question that was sent to us last night, and it has to do on how to interpret option flow, open interest, and big blocks of options that get bought or get sold. And some systems are very good at telling or at flagging when large option positions are traded. A couple of things that you want to keep in mind to interpret that information. First of all, when you see a large block of options go through, you need to know whether it was bought or whether it was sold. And there are really only two ways to guess, I would say, that part. First of all, if an option block goes off at the asking price, you can assume that it was bought. Okay. If it goes off at the bid price, you can assume that it was sold. The problem is that most option blocks go off at the midpoint, and that doesn't really help you in figuring out whether it was bought or it was sold. And the reason why it goes off at the midpoint is because sometimes the bid and ask are pretty wide, and people don't want to pay the bid or the ask, and they offer the mid. And many, many times options are priced in a way that the computers that the market makers use will trigger on the mid. So as a buyer of option, you always want to try to get done at the midpoint first. It saves you money. As a seller of option, you got to accept the fact that you may not get the ask. You may have to be happy with the mid or maybe even the bid. Now, let's assume that you can easily, your system does tell you when a block goes off on the bid or on the ask. The next thing we got to figure out is whether that buy, let's say, was to open a position or to close a position. Because let's say, I think there was a classic example that came up in the chat room last night. ULTA, which is a stock I really do not follow, had a very large put option trade go off at I think it was the 100 strike price, or something below where the stock was trading, and the stock was reporting earnings after the close. The knee-jerk reaction to seeing that put options block trade on the ask was, aha, somebody knows something, and the stock will tank. Well, not so fast. There are two other things we got to figure out. First of all, what was the open interest yesterday? Let's say that the block is 5,000 contracts, okay, and the open interest was 10,000 contracts. In other words, the amount of contracts already sold on a net basis since the inception of the contract was 10,000. Well, we don't know whether this guy was buying the puts to open his position, or maybe he had sold those options and he was simply covering them back before the earnings. The message obviously is very different. If you're buying an option to open a put option to open a position, you think that the stock is going to tank. If you're buying a put to close your position right before earnings, is because you're afraid that the stock is going to tank and you may be exposed, and you don't want to take that chance. So the dynamics are different. The second thing that you need to be aware of is whether there is a corresponding trade in another option for the same stock. Something similar to what Chris was talking about, the straddles and strangles. Now, just to throw in another name, there are many instances where stocks that are about to release earnings will have what is called a risk reversal put on. And that's in fact what this particular trader was doing last night in ULTA. The trader was protecting his long position, because what that trader did when he bought those puts was that he sold the calls at a much higher strike price. So he used the premium for one to pay for the premium for the other. And presumably that was done on a cover basis. I mean, risk reversals in that size, you don't want to do them on a naked basis because you're basically doubling down on your exposure. And if the thing goes bad, it's bad. Not to mention that the margin requirements for naked risk reversals can be enormous, especially when you do them in those sizes. Right. So all of a sudden, that big put trade did not have the same meaning as it did when you simply saw it go through on its own. And so that's how I would suggest people look at large block trades. Understand whether they were bought, understand whether they were sold, if you can, and then look at them in relation to the open interest. If the open interest on let's say today on an option is 0, and there is a block of 5,000 contracts go off on the ask, somebody is taking, in the absence of any other countervailing option trades, that someone is taking a very directional trade for that stock. Some
Phil,
of those things can be actionable.
Phil, do you have a way, or is there a way to see change in open interest, or is that something you just have to keep track of on your own from the options chain?
Well, in the Bloomberg, there are some functions that give you the change in open interest in real time.
Ah, right.
I don't even know where that is, to be honest.
Okay.
It is some pretty esoteric stuff if you can get it in real time.
Yeah.
I tend to look at it on a day-to-day basis, and that's not really that hard. I mean, if I see GE, for example, which is a name that I am long quite a few call options out to January. I keep track of the open interest on a day-to-day basis of those options that I own. And the other day, someone actually tweeted it as well. It came up that the open interest in the GE January 25 calls had gone from 27,000 contracts to 55,000 contracts over just the periods of a few days. So that, to me, is useful. It tells me that in the absence of other, again, offsetting trades, there are more and more people piling on the long side of GE for January. And, that tells me what it tells me. I mean, it's just another piece of the puzzle. It doesn't mean that GE will be at 26, 27, or 28 come January, but it tells me that there are other people who tend to view the stock the same way that I do.
Right.
So that was one question, and I don't know if
there was another question
that
came up about using puts or put spreads to protect a long common position into earnings, and how you would manage the position after earnings release, after hours.
Yeah. Well, that's a critical question. But that gets us a little bit more in depth into the delta and implied volatility concepts, and how implied volatility changes the delta, and so on and so forth. I'll try to again. There is a question in the little window that says, you mentioned YouTube videos. Is there a channel to look up for these? I'm pretty sure that
I posted an answer to that. It's if you go onto YouTube and search under MadiEyeOnSpy, there's a channel that we have there, and all the videos are listed there.
Now let me go back to that question, and I'll try to keep the answer extremely simple. Let's say that you own 1,000 shares of XYZ, and the stock is at 20 bucks, and you have a put spread of 10 contracts, which in theory, not in practice, reflect 1,000 shares. And that spread is between the strike prices of 20 and 18. The company reports earnings and the stock goes down $2 from 20 to 18. The way you can think through that position after hours is that your maximum coverage obviously is between 20 and 18. So your put spread will protect you for the amount of $2, the difference between 20 and 18, less what you paid in premium for that put spread. Below 18, it's as if you own the stock without any protection. How can you manage that? Well, the same way you would manage a long stock position by itself. Simply with the, I guess, benefit that you will have a little bit of a cushion. Now, if the price of the option, the price of the stock moves in your favor, in other words, you're long that stock and earnings are good and the stock is now at 22, something that you can do, you can probably assume that your spread position is going to take a hit, obviously, because you would hope so. I mean, it's insurance, is not an investment. But to mitigate that, you may want to lean against your puts, assuming at that point that the stock is just not going to go below 20 bucks, and certainly is not going to go below 18 bucks. And so you could think of that as a backstop to add some exposure in after hours, because those options are still there. I mean, that spread is still there. Maybe worthless the next day, but it's still there until expiration. So
that's true.
You may want to think. You may want to think about it in those terms. Now, the more I don't want to say appropriate, but the more textbook way to go about using a spread to protect a stock position is to look at the deltas, at the net delta of the spread. So let's say that you bought the 20 and the stock is at 20. We know that at the money options typically have a 50 delta. And let's say that at 18 you sold, call it 20 delta, 0.2 delta. Your net delta for the option position is 0.3. So if you have 10 contracts, a delta neutral position would be 300 shares. If you were long 300 shares and 10 contracts of the 20 put and short 10 contracts of the 18 put, you would be what is called delta neutral. And if you go into the position, into the earnings that way, and let's say that the stock does move against you, starts going down, then a very effective way of managing that position is to have figured out ahead of time how the deltas would change based on a drop in the price and put in bids that would keep you delta neutral down to 18. Understanding still that below 18 you're just going long the stock without any protection. But down to 18 you can in essence take a risk-free position. And that's by adjusting the long exposure that you have, the amount of stock that you own, to keep it delta neutral with what you have calculated to be the delta changes in those options.
Right. And in almost every case, each individual option is equal to 100 shares of the common. So if you're trying to, as you pointed out, if you have 1,000 shares, then you're probably going to need 10 options would reflect that. Again, applying it against the delta, though.
Right. So the one option contract reflects your ability to control 100 shares. But the economic value
Yes.
of one contract is 100 shares times the delta. Okay? So if you buy one option contract at the money and it has a 50 delta, your economic exposure to that stock is as if you owned 50 shares, not 100 shares.
Right.
You simply have the right to control 100 shares until expiration.
Right. And that's even diminished further if you're doing a put spread as opposed to just a put.
Correct. And then you get into the volatility on how volatility affects
Right.
the delta and all that kind of stuff. But
Right.
again, that's
Jose's original question was in fact about the put spreads, and so you would need more contracts if you're going to have a spread that than you would if you were just having a put.
Correct.
Straight put.
So.
But that just so he knows. All right. I think we've pretty much hit most of the questions that I see. And as I mentioned, I will. It takes a little while to turn this recording into the ultimate YouTube video or video that I can post links to for everyone to review it as again, or if for the people that didn't make it today. But that's the lay of the land. I don't see if there's any last minute questions or if there's any other topics or aspects that you wanted to add, Phil, that you're certainly welcome to. I think hopefully we gave everyone a good, basic sense of the options, some of the risks around them, some of the ways you can use them as tools for implementing a trade or a position for far less upfront cash. And obviously going forward, if there's anyone has further questions, we're happy to field those. You can either do it in our chat room. You can send them to MadiEyeOnSpy@gmail.com. You can also send them to me via Twitter if that's easier. My handle is CPTTE, and that's I'm happy to field questions that way also. So.
Yeah, same for me. My handle is F as in Frank, Z as in zebra, UCCHI, and I tend to post a fair amount of stuff.
Is that correct?
Yep, that's
perfect. There we go.
And you can find me also Minion Bill. I write there on a regular basis. There are a lot of articles about options, things of that sort. So.
Excellent. All right. Well, thanks, everybody, and have a wonderful weekend, and we'll see you on the stream and in the chat room on Monday. All right.
Good night, all.